Hello, and a very warm welcome to our alumni webinar with Dixit Joshi. Thank you very much for joining us. I'm Peter Maher, Director of Alumni Relations. We're joined today by Witsies around the world. And for those of you in the Northern Hemisphere and who might be homesick, I can tell you that it's a wonderful summer's day here in Joburg and campus is looking absolutely beautiful. We were promised a thunderstorm this afternoon, but no sign of it yet. Maybe it'll still come. Just a quick housekeeping announcement. You're welcome to post any questions you may have using the questions tab. And if you'd like to make a comment or observation, please use the chat function. After Dixit has finished his formal presentation, I will then select some questions and read them out to Dixit to answer. I'm absolutely thrilled and delighted to have our next Vice Chancellor, Professor Zeblon Vilakazi, with us today to introduce Dixit. Prof. Vilakazi currently has the official title of Vice Principal and Vice Chancellor Designate. He takes over the leadership reins from Prof. Adam Habib in January 2021. Prof. Vilakazi, over to you.
Thank you, Peter. Good afternoon, visitors, and good evening. But this is not about yours truly, it's about the man of the moment today. One of our distinguished alum, Dixit Joshi, who really has been a great fan of vets. Dixit is the group executive, a group treasurer of Deutsche Bank AG and is currently based in London. It's a position he has held since 2017, and his responsibilities include managing one of the largest balance sheets in the banking industry. An illustrious child of Wits alum with a degree in alumnus with a degree in statistics and actuarial sciences. He served in senior executive positions in leading financial institutions such as Credit Suisse, Barclays Capital, before joining DB in 2010. And is currently serving his third term as a board member of the International Swaps and Derivatives Association, and has been deeply engaged in issues shaping the future of global ledger technologies and the central bank digital currencies. Beyond his financial services experience, also has been a great contributor to civil society, being, among others, the board member of Pratham, a non-profit organization supporting education in India, and is a trustee of the Student Sponsorship Program in South Africa. He serves on the board of the Smithsonian Institution National Museum of African Art, and is the president of the advisory board of the National Seva Day, a social action and volunteering initiative for local communities. As I mentioned earlier, Dixit is a great friend, a proud alumnus, and a great son of this august university, the University of the Witwatersrand. With those few words, it's my pleasure to introduce you. And indeed, Dixit, was a great pleasure meeting you virtually. Obviously, due to the current situation we found ourselves of COVID imposition, I'm fortunate an opportunity of seeing you in person as soon as the situation allows. Thank you very much, and over to you, Dixit.
Zeblon, thank you so much for that kind introduction, and thank you, Peter, as well. It's a great pleasure to be taking part in a WITS alumni webinar. And I remain a proud and a committed alumnus since my time there, where I joined WITS in 1989. And throughout my career, I followed the progress of WITS, and I've always considered WITS to be a world-class university with great interest. And it was quite pleasing last year to visit my old faculty, interestingly now led by Stephen Jurish, who was one of my lecturers at the time. And hearing about the amazing work that was being done in conjunction with industry really brought home the point for me that what was true then is true now, which is that combining academic excellence with social engagement is what makes WITS a truly unique institution. And so now over to my topic for today, which is the future of the financial industry. Some of you may wonder, after the massive upheavals that we've seen this year in so many aspects of our lives, can we actually sketch out a picture of the future? And actually, I believe that the events of this year have in some ways accelerated our journey on the road ahead. So first, let's put the picture of the financial industry in context with a glance back to what's happened in 2020. We're approaching the end of one of the most extraordinary years in recent peacetime history. We've seen an economic shock that's been of unparalleled depth and speed, whose consequences will take years to play out. And in response, we've also seen packages of truly unprecedented government support measures, which have been absolutely necessary, but which have pushed public debt to record levels. We've seen restrictions on individual freedoms imposed by democratic nations that are without precedent in peacetime. And we've also seen the development of several promising and safe vaccines within 12 months of the initial outbreak, which is an extraordinary achievement in that time frame. And it is these vaccines that give us scope to look ahead somewhat positively into the post-COVID world. Already we can see the outline of some global trends that COVID would not change. Quite the contrary, I think COVID will be accelerating some of those. And so to mention a few, geopolitical tensions will remain. Under a Biden administration, we may see significant changes, but US-China tensions are likely to remain a feature of the landscape for some time. In fact, if you look at the post-pandemic recovery in the Chinese economy relative to leading Western nations, this may actually widen the gap geopolitically and impose more geopolitical risks sooner. Post-Brexit, the European Union needs to define its place in a world that's increasingly dominated by two global superpowers. For Europe's leaders, finding a unified voice and a direction will now be more important than ever. We'll also see social imbalances increase. Even before the pandemic, we faced fundamental societal challenges which have now been exacerbated by COVID. The generational imbalances have increased. Already, society faced the challenge of wealth and property imbalances between the older generations and millennials or younger. And given the nature of this virus, we have spent massively to protect largely older generations, and the debt burden and reduced employment prospects will fall largely on these younger generations. Social inequality, which was already an issue in the developed and increasingly developing world, has now been accentuated under lockdown. Many white-collar intellectual property jobs could be done from home. Manual labor, unfortunately, much less so. And if we don't tackle these imbalances actively, they'll be resolved at the ballot box as millennials and younger generations overtake aging boomers as a proportion of the voting age population very soon. And finally, in the fight against climate change, we will not go back to the status quo ante. This is about more than a change in political direction in the US. Political leaders in other nations have also signaled that post-COVID recovery and growth plans all will incorporate the transition to renewables. And so turning back to the question, what do these trends mean for the financial industry of the future? COVID in many ways, of course, has been a barrier, particularly to our way of life. But what we're also seeing now, it's been an amplifier and an accelerator of some of the trends already underway before the pandemic broke out. All of these will help shape the financial industry, and I think sooner than we anticipated. The winners in the financial industry of the future will be those players who embrace and adapt to those trends quickly. So let's look at some of these trends. Firstly, interest rates will remain lower for longer. The period of ultra low or negative interest rates since the financial crisis of 2008 and 9 will be longer and will be more global, and this has several consequences. In financial markets, the search for yield by investors would continue, particularly as populations age. As investors want yield from higher risk assets, we do need to be prepared for some bouts of volatility in future. In the banking industry, business models that relied on certain levels of net interest income need to be now re-examined. And dynamic balance sheet management becomes even more important. As treasurer to one of the industry's largest balance sheets, I've witnessed this firsthand. The second trend is the decline of cash will accelerate. Already before COVID, the era of cash, which began about 3 millennia ago in China, was already declining in favor of digital alternatives, whether as a means of exchange or as a store of value. And COVID has now accelerated this. Cash is rendered largely unusable during a lockdown or with severe restrictions on social interaction. Indeed, for most of this year, cash was not only just unusable, but was actually a health risk. The flu virus can survive 17 days on a banknote, and the average $5 bill in the US changes hands about 100 times in its lifetime. And so this trend will have a number of implications for the financial industry. One being digital alternatives to cash will spread faster, but not only as a means of exchange, but as also a way to store value. You've seen the rise of cryptocurrencies and the risks. We've seen some spectacular frauds like OneCoin, and more broadly, the emergence of more or less completely unregulated shadow banking systems with all the risks that these bring. And what this means is that policymakers and regulators will face pressure to act faster in integrating digital alternatives into the existing financial system. And so we're likely to see more work done on central bank digital technologies in this field significantly. China has built a significant first mover advantage over other leading economies. And this is all amid a wider trend, which is that digitization of the global economy will accelerate with big implications for financial industry business models. Overall, as our lives have become more digital and COVID has accelerated this has a number of implications. To state the obvious, more transactions will be online. Many commentators talk about the Amazonification of the economy during lockdown. Amazon's share price alone up this year was up more than 50%, and that's in a year when financial markets saw significant volatility. Financial service providers will have to deliver more online solutions for customers, whether that's widening the offering of desktop, smartphone banking, and perhaps use of distributed ledgers to support fast, secure, and transparent flow of trade between companies across borders. These digital technologies will also become an opportunity for structural cost saving in the banking industry, which is vital if we're to live with lower interest rates for much longer. And then from machine learning, artificial intelligence, we will see more support for tasks and decisions. We'll see further migration to the cloud as financial services firms around the world will face increasing pressure to automate infrastructure processes. And it's in this digital era that scale will be more important. As the financial industry continues to digitize, scale becomes critical not just because of the size of transformational investment needed, but also due to the competitive advantage of monetizing returns on investments over larger customer bases. And this is going to be particularly important in Europe, where both banking markets and capital markets have remained fragmented and cross-border consolidation has been slow. Of the world's top 20 banks by market value, now only 2 are from the Eurozone, and 9 of the top 10 are US or Chinese. In other words, as Europe defines its place in the increasingly muscular geopolitics of the 21st century, banking and capital market union are more important than ever. Now, the financial industry is a vital enabler in tackling the global climate emergency as well. And in the future, that's likely to be borne out in several ways as I see it. Most governments in leading economies, now joined by the USA, have made commitments to renewable energy as part of the fight against climate change. But these commitments are of such a large scale that they cannot be financed from the public purse alone. And so they're dependent on private sector investment. And in a time of regulatory constraints on bank balance sheets, the capital markets become more critical in helping turn savings globally into capital for investment. Sustainable financing is already a growth area, and this will accelerate as governments approach key targets in reducing dependence on fossil fuels, targets like the phasing out of petrol and diesel engines over the next 10 to 20 years. Sustainable financing, for example, through the fast-growing green bond market and ESG investing are likely to become part of the mainstream. And in addition, banks will come under increasing pressure to scale back or discontinue the financing of fossil fuel energy and other business activity that contributes to global warming. And last but not least, as the global economy now recovers post-COVID, very importantly, financial inclusion is an historical opportunity. In recent decades, globalization has transformed the lives of some of the planet's most disadvantaged people, lifting about 1 billion people out of poverty in some of the world's poorest nations. Nonetheless, around 1.5 billion people, around 20% of the human race, remain outside the banking system. And that is a fundamental barrier to reducing some of the most extreme examples of social inequality that I spoke about earlier. This is a great disadvantage for them. They cannot gain access to basic payments or microcredits, for example, and a disadvantage for the economies of what they are a part. Financial inclusion has made important progress. It's drawn millions of people into the financial system, but significantly more needs to be done for the good of the individuals, but also for their communities. In some cases, the barriers are tragically simple. Low literacy rates, physical remoteness, or the fact that in conventional business models, serving very low-income customers is uneconomical for banks. One of the priorities for the financial industry in the digital era is to seize opportunities to increase financial inclusion. For example, iris or other recognition and other digital ID services solves the problem of literacy, and online or telephone banking transforms the economics of low-value transactions. In a world of geopolitical uncertainties, we cannot rely on globalization to continue. In fact, we're increasingly seeing signs of glocalization as businesses think globally, but act locally. And for that reason, financial inclusion becomes not just a priority, but a social and a moral duty for the financial industry of the future. So my fellow alumni, before we start our discussion and Q&A, let me conclude. Despite the upheavals of 2020, the global pandemic has in some ways made the future of my industry clearer and may have brought the future closer. We've discussed some defining characteristics of the industry of tomorrow. We will become more digital, not only in the way we reach customers, but in the way we manage our core processes front to back. We will become more scalable as digital solutions increase and industry consolidation gains momentum. We will be more sustainable and play our part in tackling one of the great challenges facing our world in the 21st century. And we will be more inclusive, making our contribution to transforming the lives of some of the most disadvantaged of our fellow beings. If I sum it up simply, I would contrast the financial industry's part in the financial crisis of 2008 and 9 with our role in the COVID crisis of 2020. In the last financial crisis, the financial industry was part of the problem. The deregulation of our industry in the past decade, not to mention around 300 billion in fines, penalties, and settlements, reflects that. This year, though, we have unquestionably been part of the solution, transmitting the enormous and urgently needed government aid packages into the real economy, such as in Deutsche Bank's case, the German government's KfW program. And in committing our balance sheet, liquidity, and capital market access to help, customers are able to finance themselves through the crisis. And that's a remarkable difference over a decade. Our challenge and priority now is to firmly cement ourselves as part of the solution as the world faces up to many of the challenges of the post-COVID era. I thank you very much, and we'll hand back to Peter.
Thanks, Dixit. So we've got a question here from John Statulis. What is Mr. Joshi's thoughts on the role South African and foreign banks are alleged to have played in the capture of the South African state or in preventing state capture?
Thank you for the question. I must profess I wouldn't be an expert on answering the nuances of that, but what I would say, it's always been my impression, having interacted with South African bank CEOs for the last 3 decades, South African banks have been incredibly well run, have generally been fast adopters of technology, and have been able to create economies of scale. Naturally, we all bear responsibility for doing good business while catering to a variety of shareholder needs and stakeholder needs, it's very important that we're doing good business. You would have seen from my remarks that the financial industry was vilified during 2008 and 9 for much of the sort of the ills of success that came in the boom era leading up to 2007. And there were many, many lessons learned. So to the extent that, there's I think a coming to terms with practices and learning from those and embedding those in the future, I think that would be desirable.
Here's an interesting one from Joel Struess. You have a stack of books behind you. What's your recommendation from 2020? Don't know what books you would recommend we read in 2021, maybe.
That is a great one. I mean, I have a list of books that I plan to read over Christmas. They're not here on the shelf yet, but one of those is the latest book by Fareed Zakaria, looking at observations from COVID. And he's always eloquent. He's well plugged in to decision makers in the United States and globally. And I look forward to reading his book, just as one example.
Okay, and then quite a topical one with Bitcoin reaching new highs. So obviously there's some cash slushing about. So we've got two questions here about what are your thoughts on the adoption of cryptocurrencies like Bitcoin? And just another one from Jane McGregor. What are your thoughts on Bitcoin?
So, very topical given the rise we've seen in the last few weeks. So, what I would say is that the one trend that I think is now firmly taking shape is the adoption of digital currencies and central bank digital currencies, which shouldn't be confused with anonymous cryptocurrencies. You've seen, a number of the central banks now come out with initiatives, task forces, frameworks that would allow digital currencies to exist. In the Eurozone, for example, much of the talk has been around a wholesale currency, which will allow, for example, a programmable currency, the ability, for example, to deliver currency against collateral in a fairly seamless manner with no risk to either party on an intraday or a real-time basis. You saw Facebook and Libra and the initiative there, which has not gained much traction. And I would say, the general direction of travel is that I think all these initiatives have galvanized central banks to step up and again, remove frictions in the system and provide consumers with what appears to be a much needed simplicity and cost of transaction. So in my view, I don't think we will have one digital currency. I think we will have many. I think what you'd see is that the United States and the Eurozone will accelerate progress as you've seen now that China is emerging as a very clear leader. And currencies like Bitcoin will have a place, but I don't see them being used for your mainstream transactions day to day, especially given that they're not a particularly good store value.
Thanks, Dixit. So Lumkile Mondi says, thanks for a wonderful talk. The chase for yields and the allocation of capital to alternative investments for inclusion and justice. What is Deutsche Bank's thinking in this regard?
So the chase for yield, will most definitely continue. That's going to be a natural consequence of, already a decade of negative and low rates, and now with the US dollar, ultra low rates. The debate, I think any bank treasurer or asset allocator or CIO or portfolio manager will be having is how far down the risk curve do you go, or how much duration risk does one take in order to generate incremental yield? It's not an easy equation to satisfy unless you're able to flex and agree to take significantly more risk than you might have before. In that respect, we have seen, move towards alternatives over the years. Arguably, areas like private technology, you're seeing Bitcoin being a beneficiary, quite frankly, of an ultra low interest rate environment with a glut of savings, as well as perhaps some fears over the next few years of a depression or further crisis that might rear its head. But away from that, private technology may be an interesting area on a diversified basis over the next decade or two, where one might be able to create outsized returns in a very low interest rate environment. including, again, all the other secular trends around consumers, digitization, and so on.
Okay. Rushai Gosai says he works in Treasury Department here in South Africa at ABSA, working in interest rate risk management. How has Deutsche Bank protected its balance sheet since the pandemic? From a South African perspective, the key strategic directive was capital and liquidity preservation. How does Deutsche Bank deal with low interest margins and the resulting margin compression endowment effect? The hunt for yield, does Deutsche Bank see government debt as a viable investment?
So number of questions there. I mean, I think the most important being, how does a large bank navigate a crisis like this? And I think the first is, enter the crisis with a robust balance sheet, strong capital, and a good funding profile. And that's something that, we'd spent the better part of the last 3 years engineering. It was a deliberate strategy to tilt the firm towards more stable revenues, more stable sources of funding, and again, ensure that, capital resources were strong. Combine that with a framework of strong stress testing, all, helped us as we entered the crisis manage through the COVID period. It was useful to get government support. Across the globe, you've seen the number of government funding liquidity initiatives that were launched. But quite frankly, we were in a good position going into the crisis to be able to support the needs of clients, the drawdowns that we saw, to be able to navigate the crisis. So my first sort of guidance would be, have robust stress testing, make sure that you're always thinking about the proverbial rainy day, and that you're comfortable with your capital position, in peacetime, so that you're able to deal with any crisis that might occur. In terms of government bond and yields, I wouldn't make this an essay specific comment, but globally, government bonds may turn out to be not the best investment going forward, just given how low yields are, and how much central bank purchasing has been taking place over the last few years. The European Central Bank balance sheet expansion, for example, is in the region of around 3 trillion euros. And all of that, much of that money has been plowed into sovereign bonds and the like in the Eurozone. And so, one would have to seek out alternate sources of return, whether that's high yield investment grade credit, whether that's investment in longer dated income streams like renewables, whether that's solar, wastewater, wind, and other, interesting high IRR, longer dated projects, as well as, alternates, which might include property, as well as, technology, as I said.
Okay. We have a question from Naweed who said, we see interest rates at lows and stimulus at highs, record highs. Do you expect high levels of growth and inflation to follow once economic activity normalizes to pre-COVID levels, i.e. similar to the period following World War II? That's his question.
So I think he touches on one of the biggest debates in financial markets right now, and it has the market fairly polarized between, whether these trends that we've now seen will give rise to an era of hyperinflation and debasement of currency, or whether the technology impact that we've been seeing having an impact on inflation for a while now will lead to deflation continuing, or low levels of inflation over the next few years. It is my view that, we will see inflation though the timing will be a key factor, it's not my expectation that happens, in the next 18 months. But thereafter, over the next few years, I suspect we will begin to see some inflation. Just we have unprecedented amounts of liquidity flooding the system. And as we start seeing an economic recovery, it will be very hard for central banks to wean us off that liquidity very quickly. And so what you will see is an overhang of this liquidity as industries come back. And I think that will lead to inflation in the later years. But it doesn't look like that will happen for the next 18 months to 2 years.
Good evening, Dixit. Hi from Ashesh Ranchod, your school chum. You might remember me, familiar with his name. Thank you for your presentation. How do banks, including Deutsche Bank, attract deposits with low interest rates and even negative interest rates?
Ashish, hi, I remember very fondly all our days at Himalaya Secondary. Look, the challenge in the Eurozone is very much how one lives with, a huge central bank expansion of balance sheet, which then finds its way onto the balance sheet of banks like ourselves. The inability to an extent to pass that on to clients below a certain threshold, so call that sort of mass retail, and then holding that cash at the central bank at a punitive rate doesn't make for a great cocktail. And so some of the things that we've had to do are, for example, charging for negative rates to corporate and larger clients. And that's a trend that you've begun to see across Europe, and it's quite natural. So those clients then have a choice. If it is the safety of cash that they like, then they will get charged for holding that cash with us. If not, they'd be steered towards investment products or try and diversify their holdings away from euros in a manner that allows them to defray the cost of negative rates. It's a natural consequence now of doing business, and you will see many or most banks start passing that through in Europe. The thresholds at which those charges get levied will progressively be lowered as well. I doubt that sort of mass market retail, people who need their current accounts for day-to-day living and so on, will get imposed with a negative charge. But I'm pretty sure that the thresholds will be going down over time. So it is one of the challenges that we've been living through. It poses a challenge not just in the pass-through, but also in the available alternatives that one could invest in, because effectively the same central bank that's putting out a lot of liquidity is the same central bank that's also depressing yields on the best assets that one can invest in, or the risk-free rate assets one can invest in, and in that regard makes for a very tricky investment climate as well. So over time, I think what you see is a move away from net interest income, and that's a phenomenon not just in Europe but also in the US, with US rates now at almost zero.
Okay, we have a question from Linda Murray in London. Thank you for your excellent points about how the global financial industry should act now. What lessons do you have for what we teach and research at WITS to contribute to the goals you have outlined?
Look, firstly, I'm not sure WITS needs many lessons. I'm a beneficiary of the great education there, but also when I saw how well WITS has adapted through the years, I have been quite impressed. I mean, what I would say is, we live in an inherently uncertain environment. The technologies we have are evolving very quickly. No one can say that, we have a textbook or a rule book that is golden in these kinds of situations. And so the best you can do is arm students and graduates with the most flexible of skill sets to be able to cope with uncertainty. And so that's my message, which is arm students to cope with uncertainty.
Okay. We've got a question from Sandy Dutoy. Hi from sunny Canadian morning. I'm curious to hear how much responsibility you think the large banks have to help the unbanked in an increasingly digital and cashless world.
Sandy, hi. Look, I think in my remarks I touched on this in terms of financial inclusion. We have seen, whether it's due to cost or the lack of technology initiatives in periods before, that the unbanked have had to resort to fairly inefficient means of tapping financial services. Now, it might mean, a rural person living in Africa or India and having to go to a middleman with usurious charges and effectively getting ripped off along the way. And largely that's because, we hadn't solved the last mile problem in banking. Now, though, we're able to do that. Now, whether it's, M-Pesa in Kenya or it's in India with, the digital ID Aadhaar and the ability to go directly to, the end client on whether it's a smartphone or just a phone, that I think is a game changer. So in my mind, the financial system for sure has a responsibility to ensure that, we're adopting these technologies to be able to increase the scale of financial inclusion. I don't think it's an option. I think this is something that we must get done and do this right.
Dixit, a question from Apollo Dube. South Africa's loan from the World Bank Is it a good idea to uplift our economy? Meaning, was the loan a good idea?
It's hard for me to comment on specifics of a loan, but what I would say is that for, financing a bank balance sheet or financing a country involves a multitude of financing sources. And you need to be flexible around the financing that you take and when you take it, and that's dependent on the conditions within the country and your ability to repay, as well as your ability to tap financing. So in itself, I can't comment on that one facility, but what I'd say is, sitting as a bank treasurer, I know that you always want to have all options available at your disposal. What I would say is, managing towards your, better credit rating is always important. Running disciplined finances is always key. Transparency and good governance is what investors will appreciate, and in the long run will lower your cost of funding, whether you're a country or a bank. All of these, I think these attributes are fairly important in allowing you to fund yourself in an efficient way going forward. And so, those are some of the elements I would say, but I can't comment on the facility in itself.
Sure. A question from Lorona. Do you think there's a credible argument for financing coal energy projects in relation to developing countries that have significant coal reserves and acute energy power needs?
So it's clearly a huge debate right now. I mean, one thing's clear is that the financial industry, has started taking steps to ensure that, sustainable financing, green bonds, ensuring that the sustainable code of conduct has been put out there and policies are set out. Most financial institutions have been heading in that regard, including Deutsche Bank, where we issued our first inaugural green bond this year. And so encouraging a move towards green is important, but it is a transition process. And we do need to allow the markets, industry, and in this case, for example, the coal industry as well, time to transition over. And the way we do that is by not necessarily cutting off funding to communities that might need it, but it's encouraging and driving capital into alternatives that will help offset that trend. I hope that answers the question, but it is a transition that requires sensitive management. But it feels like governments, industry players, and the financial system are now quite well aligned on moving quite fast in terms of sustainable financing.
Thanks. A question from Chepo. What could be the challenges that prevent South Africa to transition into accepting EV earlier? Why does it have to take 10 to 20 years before we transition?
So, I would say one is, any transition as significant as this takes some time. The transitions globally take some time. The UK, for example, has been moving in that direction. But for example, subsidies are lower now than they were before. And so it is somewhat complex in that, a combination of, infrastructure, as in the infrastructure needs, for example, the ability to recharge and having, the sort of range anxiety that you hear about is a big deal. And Western nations haven't yet sorted that out in a meaningful way. So I think that becomes quite important. And then, quite frankly, the cost of implementation against other needs that the country might have, all will play a large part in determining how fast you go. I don't doubt that the move will happen, but it's these considerations what will determine the speed.
Okay. We have a question from Ron. What are the most important skills and knowledge for employees in the finance industry of the future?
Ron, a good question. Firstly, I'd say adaptability. If there's one thing that you learn in this industry is that change is the only constant, and so very important that the skills that you have allow you to transition as one moves from one period to another. As an example, there really aren't any meaningful banks of knowledge that can tell you about negative interest rates. The world hasn't really had significant long periods where large amounts of academic research have been done and economists have been able to dissect the end impacts well. And so what you have is you have a lot of postulation from here, And it just shows that, if you're not able to analyze data quickly, if you're not able to, have a logical way of looking at new situations, if you're not able to assess risk, I think risk assessment, risk management, risk identification, all become incredibly important in the new world that we have. So what I would say is, it most definitely is adaptability. It's being able to cope with risk. It's being self-aware. It's being able to, quite frankly, know what you don't know, are all the kinds of skills that you would need to succeed going forward. I could tell you it's it's AI and machine learning, but quite frankly, in 3, 4, 5 years time, there might be something new by the time we get there. So I'd rather focus on sort of the foundational skills that allow one to learn and adapt.
Okay, a question from Owen Sparrow. How would you recommend small and medium-sized enterprises respond to these challenges you've outlined to finance and the environment?
So really challenging space, Owen. We've seen significant pain in SMEs, as you know, globally, which have borne the brunt of the lockdowns, unfortunately. What I would say is, going forward, one of the lessons learned will be, having a nest egg and a rainy day fund. What we've seen is many of these SMEs by nature don't operate with much ability to absorb a shock. And if there is one sort of lesson this crisis has taught us, that we need to find ways for SMEs to be able to weather, some kind of a downturn, some kind of a shock. And if only for the main reason being there's such a large, source of employment in the real economy. And we've seen how devastating the impact can be of large numbers of SMEs, being impacted in the way they've been. So, to avoid a transmission into the real economy, we need to figure out a way to have some kind of shock absorber in the system, whether that's at government level, industry level, or at the SME level. Time will tell what solutions we come up with, but I think that needs to be a big focus.
Okay, a question from Craig Gradich. The South African government is looking to reintroduce prescription for retirement funds. What are your views on prescribed assets in general and whether or not this is a good idea?
So retirement funds have a much bigger challenge. I think retirement funds have the bigger challenge that, interest rates are so low, at a time when you're trying to generate returns, for pensioners, for retirees, you're having to put it into highly repressed assets, which arguably, will see much higher yields in the future, and hence makes for a very challenging environment. Which will mean that, more than prescribed assets, I think the focus should be on, how wide do we go, how wide across the risk spectrum, what's the risk budget that one's able to allocate, and moving into, by necessity into alternatives, equities, to generate, more returns than, in fixed income, certainly in government bonds over the next decade. I do think, at these levels, once central bank support starts waning, we'll start seeing a normalization of yields in government bond levels. And I think that will be almost a bigger challenge. I think prescribing shapes of portfolios and so on, one would need to see the nature of those restrictions. We all have restrictions in our portfolio construction, just so you know. As a large bank, we would have a robust risk framework, we'd have guidelines, we'd have, risk appetite levels, which would define what we can and can't invest in. And of course, that restricts, to an extent, the amount of revenue you can make. But that's always the trade-off we're having to make between risk and return. And I think the same, it would depend on the nature of the restrictions that you're imposing.
Okay, Jane McGregor wants to know, the cost of remittances cross-country from the diaspora is high. Any thoughts on how these can be reduced and more cash ending up in the hands of those in need?
Jane, this is a massive problem for emerging markets, developing economies. Remittances in many cases, as you know, make up a significant chunk of foreign exchange inflows for some of those countries and are what, locals actually depend on for their livelihood. I feel quite strongly about this topic because, having being born and brought up in South Africa, I realize just how impactful, the type of bid offers that one sees on those currency exchanges can have on, people who really desperately need that money. There are too many frictions in the financial system currently. To an extent, what you saw with Libra and the Facebook initiative was sort of a solution being proposed to allow cross-border payments that can move around, with less friction. I think you're now going to see that accelerate with central banks starting to introduce, versions of digital currency, which will allow friction to come out of that system. So I'm quite hopeful that we will see, not one, but a number of solutions in that regard, which will allow transmission of money directly to those end users in a way that will be, at much lower cost than we see today. In India, the government's been able to engineer that through use of technology, through use of, digital identification nationally, and through, for example, a payments API that they've released. And I do hope that we see much more of that in places like Africa.
Okay, I'll throw two questions to you now. Craig asks, given South Africa's poor fiscal position, will it be able to benefit from the global search for yield? And we also have another question, how does South Africa get out of junk status?
So I think on the former, I think South Africa would be a beneficiary, provided, you continue to see good fiscal management, good governance. I'm not saying without its challenges, of course, the post-COVID era poses significant challenges in all countries, but the ability to demonstrate transparency, good governance, good fiscal management with higher yields and relatively low inflation, I think will mean, South Africa should be on a relative basis a beneficiary in that regard. But the second is, let's not forget that we've had a massive dollar bull run for a really, really long time. And with dollar rates at almost zero now, what we've started to see is an inflection point in that relationship. And I would argue that is the second factor that will lead to more investment in economies like South Africa.
We have a question from an anonymous attendee. We're seeing the likes of Tesla at a market cap of 570 billion, and the value versus growth investing debate is in the spotlight again. Do you have a personal preference, investment philosophy to growing long-term capital?
So actually, I do. Time will tell how successful I am, but I do, which is really to barbell your portfolio. In my own portfolio construction, looks at, cash as a safety net, which is, arguably not the best investment through time nowadays, but nevertheless a safety net, some gold, and then separately, higher yielding investments such as renewables, in private companies that I've formed or funded or founded, and then separately, some, a pocket for tech investment, which I think through time, if you're able to tap into some of the secular trends that we're seeing, hopefully will over time, if it's on a diversified enough basis, generate some outsized returns. But I'm very much a fan of the barbell approach as I look at portfolio construction.
Carlson asks, should individuals be investing in gold right now to protect their money?
So gold has not been, and commodities in general are not great investments. If you look at the last 30 or 40 years, there are brief periods when there's some inflation and commodities do well. But generally away from that, commodities don't perform particularly well. So I'm not a huge fan, though that said, I do believe, it has a place in one's portfolio. I have a gold allocation in my portfolio, which I've written down and then written up again, which is fine. I'm not trading that as such, but I do believe it has some role, and especially if we start seeing, if we see continued very low interest rates for some time and a debasement of currencies, I think gold might do well. But again, I don't think it's as attractive as, for example, investing in equities through the long run in a particularly low interest rate environment. Just a personal view.
Sure. So I think this could be the final or near the final question is there's been quite a few questions about the financing green ventures and what your thoughts are on financing of green ventures.
So this is an important sort of construct of sustainable financing, as a means of encouraging significant capital to be directed towards financing of whether it's, the environment, social, and other governance-related initiatives. Green bonds are the first sort of, trend that you've begun seeing. I do think it's an important lever. I do think investors are quite receptive. And what you're seeing is this virtuous cycle start emerging where investors were very conscious of saying, we have a pocket that we'd like to invest in green exposure. Banks are now having to find those exposures for them, and projects that need to get funded are getting funded now because there's capital available or more capital available for those green initiatives. So, it's important. Right now it's a speciality, but my bet is it will become quite mainstream. And, in a few years' time, we won't be talking of sort of a special bucket of sustainable or green financing, but more or less everything will have a green element to it, if you ask me.
We have a question again from Rushai. How has the management of Basel as well as PRA regulations gone thus far for Deutsche Bank?
Deutsche Bank being a EU bank, not regulated by the PRA, but we interact very closely with the Bank of England, with the PRA, and with the FCA in the UK. I would say, look, probably more a general question to do with regulation. Regulators and central banks have had to adapt as well quite quickly as COVID, unfolded, and it's been quite impressive to see just how quickly central banks, regulators, but also governments have been able to put in place new programs, allow banks some latitude and forbearance to allow banks to continue lending through that period, relaxation of some capital rules, allowing leverage ratios to flex a bit through the crisis, creating new funding vehicles or opportunity or funding facilities to be able to finance through a period where there was a huge financing requirement, in the month of March and April. And so, that's been quite pleasing to see. So I think for the official sector, it's been quite a learning experience as well, because there wasn't a playbook that you could pull out where you said, you have a global stress that affects everyone all at the same time with no travel, every industry more or less shut down. I don't think anyone had even thought of a black swan. I'm not even sure what we call this now because we used to have black swans. This might be in a different category now. But even the official sector wasn't quite, familiar with this. And so pretty impressive how quickly they've got to grips with that. And so we would be interacting, to answer your question, with all of our key regulators and central banks, often on a daily or, twice, 3 times daily basis, especially during those crisis periods, to ensure that the financial system is moving and sort of the wheels are greased quite well.
Thanks, Dixit. We've reached time, unfortunately. You've been talking for almost an hour, so I'm sure you could do with a drink. It's not easy speaking for almost an hour straight. Dixit, I'm going to hand over. I can send you the questions that we didn't answer, and we can see if we can find some other format or forum to answer them. I'm going to now hand over to my colleague, our Senior Alumni Liaison Officer, Heather Bangwaya, to give a vote of thanks.
Good afternoon, everyone. My name is Heather Bangwayo, the Senior Liaison Officer in the Alumni Relations Office. I'd like to thank Dixit for today's webinar. Thank you so much for taking time out of your busy schedule at the end of the month of what has been a very busy year, a very tough 2020. You've given us much to think about and indeed left us with very valuable insight into an industry that affects each and every single one of us, whether it's as individual consumers, whether it's as organizations, or even at the level of our nation's economies. And it's for this very reason that we found this topic to be one that we really wanted to get an expert to come in and talk to us more about. We're living in a time where there are increasing concerns about income inequality, massive job losses as a result of COVID-19. And even before COVID-19, I think job losses were a thing that we were already talking about, as well as increased technology in how we purchase, how we borrow, how we pay, how we interact, pretty much every single thing that we do. I know I, for one, had wondered what the future holds in terms of social inclusion and equal opportunities for everyone in terms of accessing formal financial services, especially on the African continent, as we continue to forge ahead into the digital and tech age. So thank you so much for touching on that. I know that's one of the aspects that I had personally wondered about. I did a bit of reading about it recently, and according to the World Economic Forum, they say that it will likely take collaborative action between our financial services communities, innovation communities, academia, and tech startups. I'd like to think that's who we have on this webinar today. So hint, hint. I think we all know what we need to do, or what we could do, what we could begin to talk about and begin to contribute to. So thank you, Dixit, for shedding some light on this industry. We really appreciate it, and you've given us so much to be able to reflect on today. I'd also like to thank Professor Zeblon Vilagazi, our Vice Principal and Vice Chancellor Designate, for opening today's event for us. We really do appreciate your time for today. Lastly, but definitely not least, I'd like to thank everyone who made it to today's webinar from all over the world. Again, we are reminded just how much there are little nuggets of positivity, or we could call them silver linings. I know I've called them silver linings in the previous webinars, just how present they are in sometimes extremely challenging situations that this pandemic has thrust us into. What I mean by this is that we're able to now connect and have more of our alumni from all over the world join our webinars and these monthly sessions, whereas before, where we would have met physically at the Wits Club, most people would obviously not have been able to do that because we've got alumni all over the globe. So if we're going to look at silver linings and nuggets of positivity, I mean, we've got to, if we're going to survive, this is absolutely one of those. Okay. So ladies and gentlemen, this brings us to the end of our 2020 series of webinars. We have had extremely exciting, informative, and engaging discussions, all of which you're welcome to view and catch up on our Wits alumni channel on YouTube. They've all been uploaded, as will this one be, if you'd like to revisit it or share it. And we absolutely look forward to seeing you again in 2021. We've got a few speakers already on our radar that we're looking to invite, and I promise you, you will absolutely continue to enjoy what we have lined up for you. Until then, stay safe and good evening.